I've gone as far as saying that by the end of the decade, we'll look back and instead of concluding that it was a repeat of the great inflation of the 1970s, it might have been in some ways very similar to the 1920s. And I think we might call it the roaring 2020s. Don't fight the Fed. So when I see commodity prices, generally speaking, moving higher, it tells me the global economy is doing very well. All these people who thought that the only way to bring inflation down in Europe, in the United States, or the only way to do that was for the ECB and the Fed to raise interest rates to levels that cause a recession. Well, the Chinese did us a big favor here. They're having the recession. China's exporting deflation now. It's probably the biggest speculative bubble of all times in real estate. Europe's, I think, going through a cyclical recession, so maybe some pickup there next year with the ECB lowering interest rates will give some support to commodity prices.
Okay, Ed Yardeni, it's a great privilege to have you on the show. You're probably sick of being introduced this way, but for anyone who still doesn't know it, you are the man who coined the term bond vigilante all the way back in the 1980s, isn't that right?
That's correct.
And in October of this year, so just a couple months ago, you wrote in the Financial Times that if the yield on the 10-year US Treasury got to 5% or higher, the Secretary of the Treasury would need to have a stern word with President Biden about restraining spending. Otherwise, the bond vigilantes would be back. But since then, the yield on the 10-year seems to have settled down at 4%. So does that mean the bond vigilantes are now taking a nap?
Well, I think there was actually a response from Janet Yellen. Janet Yellen on November 1st came up with a clever way to calm them down, and that's she simply reduced the supply of notes and bonds during the auctions, and that certainly helped to trigger the rally. And in addition, at 5%, I think we did find a lot of long-only investors concluding that this was a great opportunity to buy a really good yield. And at the same time, I'd been expecting that inflation would come down sharply, and that's, I think, what's been happening. And as a result of that, we did find bond investors. Look, the bond vigilantes, I've been saying for a long time, are not the only players in the bond market. As a matter of fact, the last time they were of any consequence was back in the 1980s, 1990s, and on. We had such low inflation that the bond vigilantes basically went for a long siesta. And then, as you said, they woke up briefly there. Basically, from August 1st to November 1st, we saw that the 10-year bond yield went from 4 to 5%. People like Bill Ackman, the hedge fund manager, announced that he was shorting the bonds for all sorts of reasons, including too much supply of bonds. And then he, again, very adroitly got out of that trade. I guess he's kind of regretting that he didn't go long at 5% because we've had a heck of a rally. So the bond vigilantes are, I don't know if they're back asleep, but for now, they're not a factor in the bond market. But we really haven't seen any change whatsoever in the fiscal path, which remains out of control. And so I will not be surprised if down the road they will be back. But for now, I think the bond market's concluded, look, there's nothing that is going to happen in Washington between now and the elections. So let's focus on some other issues. And the issue right now, I think, is inflation and the Fed. And for now, they've been bullish.
But net interest costs for the US government in the 2023 fiscal year was $659 billion. And to put that into perspective, that's roughly equivalent to the entire GDP of a nation like Belgium, Sweden, Norway, Ireland, or Poland.
Right.
So it take a year's worth of work for all the people in one of those nations just to pay the interest on the US government debt. So if the scale of those figures is not enough to wake up the bond vigilantes, what's it going to take in your view?
Well, it's a good point. I think that, as you said, I mean, you look at that chart and it's just kind of exponential. It's almost vertical, actually. And I think we're up over 700 billion within the next few months. On a 12-month basis, we'll probably see the net interest cost bigger than defense spending in the U.S. So that is a really unsettling story. But what we're reminded once again, and I'm reminded once again in the bond market, is there's a lot of moving parts in terms of what really determines the bond yield. Look, for many years, I've been saying I will only care about the supply of bonds, the deficits, when the bond market cares about the deficits. And for a short period of time, they cared about it. Now they don't, but that doesn't mean that they're not going to come back and show some real concern. I think it's an issue that has been postponed for another day. The bond vigilantes have backed off and are certainly not making an issue of it right now for the Biden administration. One has to be flexible when forecasting markets.
I suppose really the comparison I gave isn't really fair because the GDP of Poland isn't relevant. The relevant comparison is government debt as a proportion of US GDP. And that's around 125% currently. And it's fallen from over 130% during the pandemic. So do you think that figure can keep coming down? Or in other words, do you think that GDP can keep growing faster than the debt mountain?
Well, I am very optimistic on economic growth, actually, but I think I'm not optimistic for now on the fiscal excesses, the amount of deficit financing, the accumulation of debt, and as you pointed out, there's a compounding effect here of interest. The government's no longer getting an average cost on its debt of 2.5%. The 2-year yield, is more like 4.3%. So it's almost twice as much. And as the debt matures, it has to be refinanced at these higher rates. So the fiscal side, as I said, nothing's changed in that regard, other than Janet Yellen came up with a trick, which is to simply reduce the amount of notes and bonds that are being issued. She basically said to the bond vigilantes, "Okay, you don't like what the deficits are, we'll finance it all in the bill market, so, and then see what you have to complain about." So I think it's a temporary development that has helped the bond market. But I think what's really helped the bond market is inflation's been coming down, and the Fed has made it fairly clear. Fed Chairman Powell in his press conference just a couple days ago made it clear that the Fed is fairly satisfied that short-term rates are where they should be in terms of the Fed funds rate, anyways, and that the next move is going to be for lower rates. And the summary of economic projections put out by the Federal Open Market Committee indeed basically implied 325 basis point rate cuts next year. So usually when the Fed's cutting short-term rates, bond yields go down.
Ed, you have a weekly show that you put on your YouTube channel.
Yes.
And even earlier you upload it, don't you, for your subscribers, your paying subscribers. And I'm an avid watcher because most YouTube finance content is very negative, predicting economic meltdown and the end of the fiat system.
Yep.
Whereas you very calmly give, at least this year, usually quite optimistic case,
right,
supported by data. And sometimes your dog even walks onto the set. It's all very uplifting, very positive. And speaking of positivity, you're calling for the S&P 500 to reach 5,400 by the end of 2024. And that would be up 15% from where it is today. So right. Can you walk us through this base case? Are there any assumptions that underlie that are key?
Yeah, well, look, on November 3rd, we wrote that we thought October 27th made a correction low. And so far that's played out pretty well. And then in a similar vein, about a year ago, when the market bottomed, we a few days later we concluded that was the low. So we're have done a pretty good job of calling lows in the stock market. But I'm looking for 5,400 by the end of next year, and then 6,000 by the end of 2025. So I think it's going to be a long bull market. And the reason for that is I haven't been in the recession camp. Actually, to be exact, I did say at the beginning of last year that we're in a recession. I just characterized it as a rolling recession that was going to hit different sectors and industries at different times, and that the overall economy would stay resilient. I've been around for a while doing this, and I thought it could play out like other rolling recessions, mid-cycle slowdowns, soft landings that we had in the mid 1980s when oil prices crashed in the mid 1980s. A lot of money that had been committed to the assumption that oil prices would stay high kind of imploded in places like Texas and Oklahoma. We had another slowdown. We did have a recession in the early 1990s. It was very mild, and it was the savings and loan crisis with commercial real estate kind of having a rolling recession. 2014-15, oil prices once again went down, and the economy slowed, and there was a lot of angst about a recession. And in the current situation, the pessimism has been widespread with a good logical explanation, simple one, and that is, hey, look, the Fed's behind the inflation curve. That was the thought at the beginning of last year, and now Fed officials are making it fairly clear that they intend to be Volcker-esque and catch up very quickly with the inflation curve and let interest rates rise to whatever level it takes to bring inflation down. And surely that's going to cause an economy-wide recession. And I kind of went against the mainstream. I didn't buy into the inverted yield curve argument, the falling leading economic indicators. I stayed with a rolling recession, soft landing scenario, and that worked out pretty well. And I think that's going to continue to be the case. People have characterized the 500 basis point increase in short-term rates and long-term rates since the beginning of last year as tightening of financial conditions. The Fed's really serious about bringing inflation down. And of late, I've been saying, with the benefit of hindsight, maybe it was not just tightening, it was normalizing. We're kind of back to where interest rates should be. They had been abnormally low between the great financial crisis and the great virus crisis, near zero. The central banks, for some reason, had this obsession with deflation, and they had this obsession with getting inflation back up to 2%. That never made much sense to me. As long as an economy is growing, deflation actually helps it grow because real wages go up. But of course, that requires productivity. And I think we're in that kind of environment now where productivity is making a comeback. And I've gone as far as saying that by the end of the decade, we'll look back, and instead of concluding that it was a repeat of the great inflation of the 1970s, it might have been in some ways very similar to the 1920s. And I think we might call it the roaring 2020s. And certainly there's analogies, there's similarities and differences, but the similarities are technological innovations that increased productivity. In the current situation, there's a major economic problem we're facing, and that is a shortage of labor. And that's what technology does. Technology solves economic problems. And I think technology is going to provide a lot of productivity growth that'll keep inflation down, that'll allow wages to rise faster than prices. It'll be good for corporate profits. And, that's the happy scenario. I'm not saying that that's the only possibility and that things couldn't go badly. But, my problem with the pessimists is it always seems to be very one-sided with them. They'll never seem to acknowledge that it could go differently. And I just try to provide more balance to that view. And as a result, because I've been sort of a loner in that regard, it seems like I'm the only optimist out there. But I try to be, people ask me, well, what do you worry about? I said, everything that the pessimists worry about. But I'm a lazy guy. They're doing all the work for me. All I got to do is kind of keep track of what they're saying, and that'll give me the whole list of everything that can go wrong. And that gives me a lot of content for my work. It's like, okay, now let's think about it. Where might they be wrong? What may they be missing? They certainly, I think, aren't talking about productivity. They certainly got too pessimistic about inflation, and I've been arguing that it's turning out to be not persistent, but transitory after all. So that's kind of my mission, not in life, but my mission professionally, is to provide a balanced view, and more often than not, it tends to be an optimistic one.
you're clearly quite a wordsmith because as well as bond vigilante, you've also coined the phrase immaculate disinflation, the
Right.
roaring 2020s as well. We'll come on to the roaring 2020s a bit later, but focusing on the immaculate disinflation, which seems very relevant given the recent dovish Fed meeting and also the fact Christmas is coming up.
Correct.
So clearly you think now that the soft landing is in, right? That it's confirmed. You're not still waiting to see.
I'm not a loner on that anymore. I mean, the FOMC committee basically has said that they think we're there, or we're getting pretty close to there. For the past year and a half, Fed Chair Jerome Powell has been saying that he thinks that there's a very narrow path that we might be able to go down, and maybe we'll get inflation down without a recession. But of course, he said that's a very narrow path, and he basically suggested that it wasn't very likely, but he was hopeful. And now they're basically talking as they're not using the word mission accomplished. God forbid that they ever say mission accomplished, because that'll be a jinx. But they're kind of close to that. And the summary of economic projections that reflects the consensus view of the committee, the Fed's Federal Open Market Committee, that certainly is a soft landing scenario. And, all the financial press, the headlines are, basically heralding that we're achieving or have achieved a soft landing. So, yeah, I think we're kind of there, and it speaks to the resilience of the economy. It speaks to the resilience of the U.S. consumer. Some very smart people who have been pessimistic, people like Jamie Dimon, the head of J.P. Morgan last spring in May of 2022, was saying, right now things look pretty good, consumer looks pretty good, but he said that's all because they have all this excess saving that they piled up during the pandemic, between saving for a couple of months during the lockdowns and then getting 3 pandemic relief checks from the government. But he predicted that they would run out of it within 6 to 12 months. Well, here we are 6 to 12 months later, and they probably have largely run out of that saving. So what's keeping the consumer going? Well, I think, again, what the bearish side of the argument has missed is there are some very powerful forces keeping the consumer going. And one of the more important ones is one that I have a competitive advantage in relative to the younger forecasters. I'm a baby boomer, so I know my people. And there's 75 million of us, and I'm still working for a living because I don't know how it happened, but I got 5 kids, and 2 of them still need me. But I'm not retiring, and I love this business, so it keeps me young. But a lot of my friends only had 2 kids, and the kids are adults. And my friends are, sat around during the pandemic and thought about the meaning of life and concluded it's all about going out to restaurants on a regular basis, traveling around the world, and then, oh, by the way, stopping in to visit the doctor just to make sure everything's all the clocks are ticking properly. So I think the baby boomers are keeping the economy going. 40% of people with houses in America do not have a mortgage, and a lot of them are older baby boomers. Net interest payments, as you said, by the government are an all-time record high. Well, again, let's balance it off by recognizing somebody's getting that interest. There's a lot of fixed income people dependent on fixed incomes that are just overjoyed at finally getting a good return on their money. Dividend income is at an all-time record high. So there's a tremendous amount of income flows to a lot of people that are retiring. And guess what? They're not saving anymore. They're spending.
And how many rate cuts are you expecting next year? Because the Fed said in its last meeting that it forecast 75 basis points worth of cuts. Should we believe that?
Well, economists, Fed watchers in particular, generally speaking, tend to be critics of the Fed, and they kind of view the people on the Fed as clueless and clowns. And so whatever they say, go the other way. Then again, whatever, whether they're making sound policy or not, they do run monetary policy. Not all the clownish Fed watchers, and as a result of that, I think it was Marty Zweig back in the '70s coined the phrase "Don't fight the Fed." So whether you agree with what they're doing or not, a lot of Fed watchers, I think, aspire to be chair of the Fed. That's not my aspiration. I think what we've got to do as Fed watchers is say, okay, what are they thinking? Where are they going to go next? And they tell us they try to be very transparent. And right now they're talking about 75 basis points in cuts next year. And again, the critical Fed watchers are going to say, well, no way that's going to be right. They're always wrong. And by the way, I think the real contrary forecast for the past 2 years is to bet that the Fed's actually going to get it right. And so far, so good. But I think the Fed is probably going to cut by 2 or 3. I don't expect 4, 5, 6. And again, that has a lot to do with the economic forecast. I don't see a recession next year. I see actually rolling recoveries. I think we'll start to see some recovery in the housing market with a drop in mortgage rates. I think we'll see some pickup in retailing. It's been very depressed because consumers spent a lot of money on goods coming out of the pandemic. Went on a buying binge. They couldn't buy services, so with their excess savings, they bought a lot of goods, jammed up the ports, jammed up the trucking systems, and by the time all this stuff arrived at retailers, consumers said, "No mas, we got enough. We're going to go on vacation on a regular basis, every other month. We're going to take long weekends. After all, a lot of people now work from home, or it's hybrid, so they can always say, hey, we're working from home on Fridays and Mondays, and what they're really doing is getting on a plane and traveling somewhere and working, from from the beach with their laptop."
As we mentioned earlier, another term that's attributable to you is the roaring 2020s. And this term might catch on more widely if the strength we saw this year really does continue. Right. But then more commonly, we hear the 2020s compared with the 1970s. And the late 1960s, of course, saw the US trying to spend on both guns and butter, the Vietnam War, and domestic priorities. But isn't that what's happening right now, with tens of billions going to the Ukraine and Israel at the same time as the Biden administration shells out on green spending and all kinds of other initiatives?
Yeah, the whole thing, yeah. No, that's a very good point. And, again, I try to be balanced about these things. And when I coined the term roaring 2020s, it was around 2020. And I said that the alternative to the roaring 2020s is because of the excesses of fiscal policy and monetary policy, it could turn out to be the 1970s. And I didn't give that a very high probability at that time. And then I started raising the probability of the 1970s deja vu all over again as inflation actually reared its ugly head in 2021 and 2022. Like everybody else, my first instinct, not like everybody else, but like Fed and other folks who looked at inflation, we all at first thought it was going to be transitory. Then it looked somewhat more persistent. But I argue that a lot of the inflation was pandemic related. The supply chain disruptions were the source of inflation in goods, and in goods inflation went straight up and went straight down. It so far has not been kind of the Twin Peaks of the 1970s. I mean, if the war in Gaza becomes a regional war in the Middle East, all hell breaks out, and Iran either supply is disrupted or they disrupt the Strait of Hormuz, then certainly we'd have a second oil shock, the way we had at the beginning of last year with Russia's invasion of the Ukraine, and then we could be looking at something that we've seen this movie before. So it's it's a plausible, possible scenario, but right now given, as you said, that this year so far, we get kind of more of this, and people will be acknowledging that the roaring 2020s is a legitimate scenario. Then, of course, they'll tell you, yeah, but it ended badly. So let's worry about that at the end of the decade, and we'll revisit that. But yeah, government policy typically can get us into trouble. I mean, the 1920s ended badly, I think, because of the Smoot-Hawley tariff that killed global trade. So the government's perfectly capable of coming up with something that kind of quashes this thing. And you may very well be right. And we just discussed this earlier, that the deficit hasn't, nothing good has happened on reducing the deficit, on cutting back on the accumulation of debt, the interest costs of the government. These are all issues. But if it's the roaring 2020s where productivity growth goes from currently on a 5-year trailing basis at an annual rate, it's 1.7%, which is pretty good, actually. It's up from 0.5% back in 2015. So we've already tripled the pace of productivity growth. And looking ahead here, I think it could go to 3.5 to 4.5%, which sounds completely far-fetched, if not delusional, I admit. But when you look at a chart of the productivity numbers that we have going back to the late 50s, there was a productivity growth boom cycle in the 50s. There was one in the mid-60s. There was one in the second half of the 90s. And all three of them got productivity growth to be up to 3.5 to 4.5%. I mean, if we do that again, that would be fantastic, right? I mean, it all goes straight into real GDP. And as I said, wages can rise faster than prices. It's the exact opposite of a wage price spiral.
This YouTube channel is called Resource Talks because many of the listeners are very interested in precious metals and mining stocks, things in that area of the market. So you alluded to the possibility of there being an oil price shock if the war in the Middle East sort of becomes no longer so contained as it is in this moment. And then, of course, the other big narrative out there is green policies that seem to be set to drive up the demand for metals like copper and lithium, nickel, cobalt. What's your outlook for commodities as a category in general in your base case of roaring 2020s? What would that mean for commodities?
Yeah, it's a good question. I'm a big daily fan of watching commodity prices. I use them as tools for assessing what the economy is doing and for kind of fine tuning my forecast. So when I see commodity prices, generally speaking, moving higher, it tells me the global economy is doing very well, and it's fairly broad. When commodity prices are going down or staying depressed, it tells me that the global economy is not doing so well. The message I'm getting right now from the commodity markets is, yes, as you said, on the bullish side, there's the demand for all these metals that's related to the transition from fossil fuels to clean energy. But while all that's going on, China just fell into a pretty significant recession, if not an outright property depression. I think it's bigger than what we had in the United States in the great financial crisis of 2007, 8, 9, 10, and so on. I think it's bigger. Their property market depression is bigger than what the Japanese went through in the late 1980s, and then how that created a lot of deflation for them in the 1990s. It's probably the biggest speculative bubble of all times in real estate, and we all know how the game was played. The provincial governments would sell land to developers. The developers would build ghost cities. The ghost city apartments would be bought by Chinese investors who have a high savings rate and wanted to diversify, and so they bought the empty apartments. The cities were very well maintained and groomed. They didn't buy them to rent them. They just bought them to own them, and the prices would go up. And so they had a positive wealth effect. And the provincial governments would take the cash that they got from selling property and built state-of-the-art infrastructure. And it all worked until it didn't work. About 3 years ago, President Xi started to worry about the speculative bubble, and he said, maybe we need to slow this thing down and do some things to make credit less available. And that basically put the pin into the bubble, and it absolutely burst. It didn't take much, just some slowing down in the availability of credit to that sector. And the government really can't reverse course because they, what do they do? Blow up an even bigger bubble that'll, just blow up another time. So they kind of saw the problem and then tried to deal with the problem. But by the time they did, it was kind of too late. So now they've got prices falling. They got developers, stiffing everybody on payments. And as a result of that, the consumers got a huge negative wealth effect. People don't seem to appreciate that the MSCI Chinese stock market's down over 50% over the past few years. So they've got a negative wealth effect from stocks, a negative wealth effect from property, and the Chinese government has been trying to change their economic model away from being export and infrastructure dependent to being consumer dependent, and it's simply not working. Meanwhile, the Chinese Communist Party is responsible for the one-child policy, and it's now coming back to haunt them. I've been arguing that China's taken the title away from Japan. Japan used to be the world's largest nursing home. Now it's China that's becoming the world's largest nursing home. And old people just don't spend. They don't go anywhere. I mean, they built all these state-of-the-art airports, all these state-of-the-art trains, and the demographics isn't going to support all of that infrastructure. So going for another splurge in infrastructure spending is a waste of money and isn't going to make any difference. So the bottom line is, all these people who thought that the only way to bring inflation down in Europe, in the United States, or the only way to do that was for the ECB and the Fed to raise interest rates to levels that cause a recession. Well, the Chinese did us a big favor here. They're having the recession. They're having deflation. Their CPI is falling on a year-over-year basis. Not much, but it's falling. And the PPI is falling like by 3%. And China's PPI tends to be a pretty good indicator of the PPI in the United States for goods. And so China's exporting deflation now. And I see that in commodity prices. That's kind of the message I see. I mean, copper's just kind of sitting there. The price of oil, the Saudi Arabians, the Iranians, the Russians would love to have the price of oil at $100 a barrel. And maybe this time, if they could get it, they'd be rational enough to just keep it there rather than to kill the economy with 120. But the market said, that's not the right price. 100 is not the right price. There's demand destruction that occurs. Americans simply drove less. And by the way, because of the pandemic, a lot of people are working from home. So there's been a sort of structural demand shift for gasoline. So a lot of the driving is actually increasing locally. And if it's $4 to $5 a gallon, people say, I'll go out and do my errands all in one shot instead of at different times of the day. So that's the way I'm looking at it. And I think for now the recession, depression in China is offsetting what other positive factors that, as you mentioned, should be pushing these commodity prices up. So I think that persists because I don't think China is going through a cyclical recession. I think they're going through a secular structural recession. They can't change their demography. They can't overnight fix the consequences of bursting their speculative bubble. Europe's, I think, going through a cyclical recession. So maybe some pickup there next year with the ECB lowering interest rates will give some support to commodity prices. But look at the price of natural gas. I mean, it went off the charts when Russia invaded Ukraine, and people said it would take 3 to 5 years before they could get supply chains redone so that there wouldn't be a shortage of natural gas in Europe. And here, it's already been snowing pretty badly in Europe. Anyways, it did just before the climate change conference that they had. A lot of people of the participants got stuck in the Munich airport. But price of natural gas keeps going down. Why? Because there's lots of it. My attitude towards commodity prices is what we all know. The best cure for high commodity prices is high commodity prices, and the best cure for low is low commodity prices. But I think that adage is probably asymmetrical. High commodity prices will cause demand destruction. Low commodity prices may be reflective of a structurally weak global economy in which China is depressed, Europe's recovering, and the U.S. is doing okay.
There was an interesting report in Reuters yesterday based on an analysis of Chinese import data. And they said that you could tell that China's gone from, over the last decade, buying commodities at whatever price to feed its massive growth rate, to a new model this year where now it's very tight, very price sensitive, and it goes to accumulate reserves in commodities when they're trading down, and it avoids accumulating when they're trading up.
I look at the monthly the aggregate data, and it sounds like you're looking at some of the disaggregated data on commodities, but looking at the aggregate data, imports in yuan have been flat for about 3 years, and exports have been flat for about 2 years at record levels, but there's no growth. So that's very meaningful.
So the roaring 2020s then is not necessarily a boon for commodity prices.
No.
The driver for the roaring 2020s is, of course, productivity gains.
Productivity. And technology, yeah.
But at the same time, I caught your latest episode of your podcast on your YouTube channel, where you made some derisive comments about ChatGPT and Bard. You said that they make a lot of errors and that you just have to spend more time correcting all their errors than you save. So if it's not that type of technology that's going to bring us massive productivity gains, what type of technology is it?
Yeah, well, there's a lady that works with us, Jackie Dougherty. She used to work for Barron's many years ago. So she's a contributing editor, and every Thursday, Jackie's really the one who writes it, and I just we have discussions about it. We write about disruptive technologies. If we're going to be talking about technology disrupting the global economy and creating more productivity, we've got to stay informed about it. You can't just wing it. And so we're really impressed by how many technologies there are out there that can be used collectively, including artificial intelligence, but also quantum computing. There's a lot of progress being made there. And of course, 3D manufacturing, nanotechnology, and the whole world of robotics and automation. All these things are not independent technologies. They're all in an integrated fashion can be used to increase the productivity. What is unique about this productivity cycle, as far as we're concerned, is that the technologies that are out there lend themselves to increasing productivity in all firms. So from that perspective, one of our investment thesis is that all firms are technology companies. They either make it or they use it. If they don't use it, they're going to be out of business. And as investors, we want to invest in the companies that are using technology to increase productivity and stay away from those that don't do so. But yeah, during the one of my web chats, I was asked. Somebody noticed on my screen that on my browser, I have ChatGPT as a file, and so I got Bard in there and the others. And when this thing first came on, I immediately signed up and paid the $20 a month. Now I'm not paying for it anymore. And the reason for that is I said, oh my God, this is great. I'm not going to have to work for a living. The clients aren't going to know this, but Bard's going to do, one of these artificial programs is going to do all the work for me. And all I got to do is kind of read it to check it. It took me more time to check the fact check and realize how much is wrong than to actually write the damn thing all by myself. So from my perspective, it hasn't been a real success, and I'm not using it. But then again, several years ago, we came up with a chart program that automatically updated on the charts on our webpage. And that was sort of a crude artificial intelligence program in the sense that our server queried the servers where the data came from and said anything new for us. And if there was, the charts would automatically be updated, and the publications they went into would automatically be updated. So we're using technology. I don't think I'd exist without it. Let me just hang up on this person, whoever's calling here. Okay.
Shifting gears a bit, I'm sure you've heard about the new right-wing president of Argentina, Javier Milei, who ran on the idea of adopting the US dollar as the national currency to combat hyperinflation in the country. Right. Do you see that as being significant at all for the relative price of the dollar against other currencies if it's suddenly adopted overnight by a nation of 60 million people?
Yeah. Well, I don't spend much time on individual currencies. I do look at the trade weighted dollar. I look at the DXY index, and we do it from a macro perspective. And just the way I look at commodities, I clearly have a forecast on commodities based on my forecast of the global economy. Again, from a macro perspective, I'm a big fan of the CRB Raw Industrial Commodity Price Index. It's got 13 raw industrial commodity prices. It doesn't include lumber. It doesn't include oil. So I like it for that because I think they have their own dynamics. I don't do really any work on agriculture other than observe that every time it spikes up and people get all frantic Malthusian about it, we find the price comes right back down. So with regards to the dollar, on a chart, it looks like a pretty strong inverse correlation with commodity prices. When the dollar's strong, commodity prices tend to be weak. When the dollar is weak, commodity prices tend to be strong. So a lot of that has to do with the global economy. So when China was leading a global boom in the 2000s up to 2008, the dollar was very weak. The global economy was very strong. Commodity prices were very strong. Since 2008, the global economy has been kind of mixed. The U.S. I've been telling people overweight the U.S. Since 2008, and so far it's worked. One of these days I'll overstay my welcome with the idea of stay home versus go global. But it's still working pretty well. The U.S. economy is doing well, and other economies are challenged. China's challenged. Europe's challenged. Part of it is aging demographic profiles. Maybe the offsets will be India and Africa, where there is potential for lots of growth. But I would say that from a geopolitical perspective, the dollar clearly always was and continues to be a political issue. De Gaulle never liked the dollar, and so Nixon back in the early 70s says, "Well, if you don't like the dollar, too bad. We're not giving you gold for it." And so he closed the gold window, and that was was one of the reasons that the inflation of the 70s was precipitated by the closing of the gold window. The dollar collapsed, and commodity prices soared. I don't see that kind of scenario now, but there are clearly autocratic regimes in the world, axis of evil, as some people might call them. I would call them that. Russians, Iranians, for example, maybe Venezuelans, that Chinese Communist Party, not the Chinese people. But there's some bad actors, from my perspective, from a purely American perspective, clearly, that basically don't like the global world order where the U.S. is calling the shots, and want to replace that with not so much a multipolar world as one where the U.S. is irrelevant and they are very relevant. So we see what China's doing in the South China Sea. We see what Russia's doing in Ukraine. We see what Iran is doing in the Middle East. So they're all trying to topple the U.S. And another way they're doing it, they say, okay, let's all get together and have our own currency. Let's just trade with each other. We can't, the U.S. and us just, oil and vinegar, we don't mix. And as a result, there's a lot of talk about, the dollar's in decline. But I don't see that. I think from an economic standpoint, if you're doing business on a global basis, do you really want to be doing it in a currency that's dependent on the word of the autocrats in Russia, China, Iran, or do you want to do it with the U.S. dollar? So I think the U.S. dollar remains relatively strong, especially in a roaring 2020 scenario where, look, no other country has the kind of technology industry that we have. I mean, the so-called Magnificent Seven, they're all American companies. Nobody really talks about anything particularly magnificent overseas. I'm not denigrating that there are great companies overseas, but in terms of technology, it's the Magnificent Seven, and they're in the U.S. Obviously, they're global in nature, but a lot of our technologies are very relevant. The Chinese certainly have come along extremely far in technology, but a lot of it's being used for autocratic purposes to maintain social scores, to read your face and see what you're doing. We're not using technology for that purposes, not to that extent, anyways. What
about all the innovative companies listed on the British FTSE 100, like Vodafone or Philip Morris or Rio
all great
Tinto?
companies. I mean,
not innovative,
great,
though, are they? They're all dinosaurs.
Yeah, all great companies. All I'm saying is, with regards the thesis of the roaring 2020s, is I don't think any of those companies are going to, with the benefit of hindsight, at the end of the decade, we're going to look back and say, oh, thanks to Vodafone and some of the other companies you mentioned, productivity soared and the standard of living improved and inflation stayed down, and all the pessimists were wrong. I mean, not to say that things can't go badly, and 1920s did end badly. 1920s we had a couple of very conservative Republican presidents who had this laissez-faire attitude and let the market operate. Clearly, that's not the case today. And as you said, the government is bigger than ever and more out of control than ever. But my again, when I try to provide a balance to the pessimistic view, the pessimistic view is look at how out of control government policies are and how they're going to screw up the economy. And my counter to that is, well, look how well the economy's done despite Washington, despite the Treasury, despite the Fed, despite the White House. And my position is that as long as we have a relatively free market system, and we could spend hours on that, but I use the word relatively free market system, where entrepreneurs can still find funding and can still bring things to the market that the market might actually really want, and get productivity gains and increase the standard of living. We do that pretty well in the U.S. And to that extent, that's a tremendous offset to, all I'm saying is American capitalist entrepreneurs and others around the world are saying, how can I make things better for myself, my family, my community, my country, despite the government? How do I factor in, how I got to deal with the government and yet still make all these things happen?
So the message I'm getting loud and clear is that you're bullish on the S&P 500. But
yes.
Then let's take it to a more granular level.
Sure.
So what about the debate about mega cap stocks, which have already rallied massively this year, names like Nvidia and Apple, Microsoft, versus small cap value stocks? Would you be more inclined to go for an equal weighted S&P 500 index or a market cap weighted one?
Well, the bears, the pessimists have been saying for the past, really since the bull market started in October of last year, is that it's really not a bull market. It's just 7 stocks going up. They're big, and the rest of the market, look at it, it's barely budging. Such a narrow bull market can't be sustainable. It won't be sustainable, and we're still in a bear market. We haven't gone to a new record high. Well, we're pretty close to a new record high right now in the S&P 500. The Dow's there, the Nasdaq's basically there. But again, you can attribute some of that to the roaring Magnificent Seven. They've had their own little roaring 2020s so far. But I've been arguing that it's been narrow, but you know what happens next? It might actually broaden. Why does it have to? Why does it have to be that if it's narrow now, it therefore implies that the bear market comes back? Why couldn't it broaden? And that's exactly what it started to do on November 13th. I don't know what it was about that date, but that's when the equal weighted S&P 500 started to outperform the market cap weighted S&P 500. The market's broadening. And we've seen some double-digit increases here in the SMID caps, small caps, mid caps, financials. We've liked financials ever since the banking crisis. We said that this is not the beginning of the new great financial crisis part two. This is an opportunity, and they've done extremely well. We like information technology still, even though expensive. Look, the mega cap 8 aren't going to go away. They account now for almost 30% of the S&P 500 market cap for the market cap weighted index, and they're highly prized, they're highly valued. They generate a lot of cash. Interest rates really don't affect them much at all. They're in the driver's seat. I mean, they see everything going on in the technology world. So I think you stay with them. As we've seen, look, I mean, the roaring 2020s thesis got a pretty big boost from the what people call the hype about artificial intelligence. I agree that it is hype in terms of being something I can use, but we're constantly researching and keeping on top of the developments, and it is having some significant impacts on productivity in different industries. But again, it's not the only technology that's out there. Elon Musk is developing some pretty cool robots. And he's not doing that for fun. He's doing it because he wants them to build cars. And so there's a lot going on here that suggests that the market we're in a bull market. It could be a major bull market, certainly in a roaring 2020 scenario. And that's my story, and I'm sticking to it as a perpetrator told the cop.
Well, just from my very ignorant perspective, I feel like robotics is the most overhyped technology, because when you see videos of these machines that they make, they look about as rigid as C-3PO, and I'm not really sure in what the applications are.
Yeah, well, a lot of the automation in robotics is, I mentioned American companies, but there's some Swiss and German companies that make extraordinarily well-engineered manufacturing systems that increase productivity dramatically. I do talk, at least in the United States, to small manufacturing companies, and they all have their stories about how they're increasing productivity. Things that used to take them weeks to produce now with some of the. I said, where do you get the equipment? I said, well, not the U.S., it's Germany and Switzerland, Japan too, by the way. So you're right. I mean, there's just some things that get the headlines, get the YouTube videos. But it's too bad that there aren't more YouTubers asking to go into factories and seeing how these things actually work, how they actually manufacture, and talking to the folks and say, well, is this the way? How long have you been doing it this way? And many of them will probably tell you, we've just been doing this for the past 3 to 5 years, and it's dramatically increased our productivity.
Mm. It seems like all the robots out of Japan are like sex robots. Maybe that's just my search history speaking.
Yeah, that's your search history. Yeah, I don't go there.
Anyway, Ed, it's been a great privilege to speak with you and benefit from your decades of experience. Is there anything that I haven't asked you about that you'd like to mention before we finish?
Yeah, well, we mostly have been working with institutional investors in my career. I've been doing this for 40 years. About a year and a half, 2 years ago, by popular demand, we came up with a more affordable research product for individual investors. And so you can have a look at it at www.yardeni, quicktakes.com. So that's one word, YardeniQuickTakes.com. And it is designed to be a quick take. You can read it really quickly. But what we try to do is explain how the macro indicators that come out on a daily basis, how the markets are responding to them, what the surprises were, and try to anticipate. We do it on the weekends. We put out a review of the calendar ahead and say, okay, the CPI is coming out. What do we think it's going to do? What are the indicators showing that it might do? How much of a surprise would it be to the market? And of course, we're Fed watchers, so we spend a lot of time trying to figure out what the Fed's doing, and that's in our analysis of that work. And then you can go on Amazon.com. I think I've written, I forget how many, 5, 6, 7 books on predicting the markets, and kind of what I've learned over the years about what's relevant and not relevant. For a long time, I concluded that the supply of bonds isn't relative. Then I thought for a while that it might be relevant, and now I'm back to thinking, well, right now only inflation matters. So have a look.
And are you on Twitter or any other social media where people can go to follow you?
Yeah, a lot of I do appear on LinkedIn quite a bit. Some of that manages to get to X. I don't do Facebook, but so yeah, there is some social media, and of course I do I have a YouTube channel with the weekly web chat with a 1 week lag for the public.
Fantastic. Ed, thanks again for coming on the show.
Sure, my pleasure. Thank you for the opportunity.